gods of technology have smiled upon us.
It's a good day.
It's a good day. It's a good day. Yeah. Pretty sure we're already live on YouTube and I'm going rock. Yeah.
Yeah.
All right, but let's start webinar. And you ready?
Game on. You gonna look ready?
I wanted to see the numbers 77,500.
Yeah. Yeah.
Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. What just happened back here? Do you see?
I don't know. Right on cue, buddy.
Are we doing this in real
Here,
time?
you do that. I'll work on this.
Look at this. I can do it all.
You're the man.
Welcome to the Not Your Average Investor Show. $77,500. That is what a new statistical report, a new report has shown is what the average Florida resident needs to make in income in order to afford the median household rent for a 2-bedroom apartment. Does that mean that Florida is unaffordable? Are we topping out of this market? We're going to examine that. We're also going to talk about rates. People keep on predicting rates going up, then all of a sudden they go down, and now they're going to talk about going up again in September. We're going to make sense of all of this today in today's Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flows, is a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
It's good to be with you, buddy. You sent me a text last night saying you were feeling a little under the weather, but you're trooping on today for the show.
You know, the show must go on, baby. We're here.
The show must go on. And, normally when the show goes on, we have a little tradition. Do you remember what that is in your...
The roll call, baby.
All right, who we got here in the roll call? We got the MVP checking in first.
Mr. Lee Bishop.
Mr. Lee Bishop. Nice to be with you all today. He says we got our leadoff hitter batting second.
John Henning.
Mr. John Henning. We got El Del Gran Amigo checking in.
Early today. Temprano today. Bill Shields.
With a... good to have you, Bill Shields. We got Mike Harden in the house.
My buddy Mike. Nice to see you, bud.
Good to have you, Mike. We got the Shaw man of the Not Your Average Investor. Nadeem Shaw with his trademark good morning, good afternoon from the West Coast. We got the Maven from the mountains of Denver.
Ms. Leslie Wilson.
Leslie Wilson. We got
Billy Green
from the Misty Mountains of Colorado. Good to have you. We got Eddie Harris from
Atlanta.
We got Saran with a plan.
Saran Jennings.
Saran Jennings in the house from New Jersey. We got Alejandro from Tampa checking in.
All right, Alejandro.
Good to have you back. We got the KOB, King of the Beach.
Christopher Lee
from Fernandina Beach. Good to have you in the house. HCTN is back.
Happy Taco Tuesday.
Happy Taco Tuesday. Indeed. John Seabird is in here.
All right, John. Great to see you. Two in a row, I think.
He's becoming a true regular out here.
He knows where it's at, right here.
He knows where it's at. We got the ringmaster.
Andrew Barnhill.
Andrew Barnhill checking in. We got your buddy Belinda.
My buddy Belinda Baldwin checking in.
Good to see you. Dallas, Texas. Good to have you, Belinda. Who else we got in here? Diane Jacques from Massachusetts.
Is that a new name?
I think that's a new name.
All right. Diane, welcome to the party.
Welcome to the party. If you're new here, the best thing to do is make friends in the chat. These are all real estate investors that may or may not be doing business with JWB, but they're all super knowledgeable. So be active in the chat and ask for opinions and make a friend. We got Ron Mello in the house from Pleasanton, California.
Right,
Ron's making a habit of coming.
Ron is making a habit. He's eerily close to a nickname.
Speaking of someone with a habit, Linda Evans from the Villages.
Hey,
Good
Linda.
to have you back, Linda.
Nice to see you guys.
Yeah, buddy. Mike Harden's from Philly. That's your buddy, Mike Harden.
Mike Harden, almost super close to being a Jacksonville resident too. Ooh. He is very, very
like
close.
Right now. He's in the process.
He's in the process. I was talking to him not too long ago. I was telling him about you. I was like, hey man, you got to be down here. So I think it's only a matter of time.
Mike, if you ask me my opinion, just do it. Who else we got in here? Phil from Maine. Phil, new name.
Phil Doherty. All right.
Phil Doherty. New name?
I think that's a new name.
The new name, Phil.
Right.
Welcome to the show.
Welcome.
Make it a habit, buddy. Make a friend in the chat, and you'll keep coming back. Speaking of people that make friends in the chat, the fairy godmother of the Not Your Average Investor community is in the house.
Jen Filzen.
From the lovely Monterey Peninsula. Good to have you, Jen Filzen. We got Justine Herrera from Burbank, California.
There you go, my ride-along partner.
Your ride-along partner, future star of the show, coming up in a couple of weeks. Justine. Laura Colby from Washington State. Laura.
Hey, Laura. Nice to see you.
Great member of the community as well. Good to have you, Laura. This has been a good one, man.
All right.
Greetings from NYC. If you check in from the chat, it says not your average guest, and I'm not exactly sure who you are. So whoever checked in from NYC, let me know who you are so I can call you by name. Good to have you here, though. And David Blattner is back in the house from Massachusetts.
Fantastic.
Who else we got in? Oh, the early bird is here.
All right, Dean Curry.
Long time no see, Dean Curry. You feel free to come in. Late bird also gets worms too. Dean, you're good. You're welcome here at any time you want to.
You switched it up with El Gran Amigo today.
Yeah, you the Gran Amigo. Yeah, I like it. So that way, before we get into this, breaking news, GC. Recently reported the average JWB renter after 13 months of occupancy, their credit score increases by 77 points. When they first start renting, the average renter at JWB has a credit score of 627 points. And within 13 months, because of the resident benefits package that we all offer here to our renters, they increased to 705 points on their credit. That's a big deal.
So this is a big deal.
Yeah.
Our average renter who rents with JWB has a credit for longer than a year, has a credit score of over 700. Just think about what that does for those who are renting today and who are want to become homeowners in the future, and what we can do to help those folks as a property management company. So we do this reporting. I think we get this report once a quarter, and it helps us understand what things are being done to help our residents take a step forward. I saw this and we eclipsed over 700 as a credit score once a renter rents with JWB for longer than a year. And I was like, man, this is awesome.
Yeah.
So that person gets to be in a position to buy their first home, or for their existing loans, the interest that they spend on those existing loans goes down.
Mm-hmm.
There is a whole bunch. I mean, it's much easier to be able to rent a home too, because your credit score is sometimes used to rent a home or for utility payments and things like that.
What's making their credit score go up?
So we report positive rent payments to the credit bureaus.
Okay.
And that is not normal. Normally when people are renting houses, especially from, mom and pop landlords and whatnot, it costs money to report that trade line to the credit bureaus.
Mm-hmm.
And most people don't even know how to do it as well.
Yep.
But we saw that as an opportunity to help our residents become future homeowners. And so many years ago, we started to report those positive trade lines. Mm-hmm. And now you can see the fruit of that labor, an average gain of 77 points for our residents, which is huge.
I feel like that's another exercise in really well aligned incentives, which is, I think, what you guys do really well as a business, right? Like if you are reporting credit for them, it means now it's in the resident's best interest to pay on time, because obviously bad payment is not going to do well. But when they pay, then they're improving their credit, like you said, and they're more likely to become homeowners, qualify for better jobs, have less debt, those kinds of things. And it's another kind of like positive flywheel of aligned incentives.
You know what? We really want to be a part of situations where everybody can win, where the renter can win, where the investor can win, and where JWB can win in the long run. And this is a great example of that. The renter can win. And if you think of yourself just differently as a property management company from just that, old, relationship of landlord and tenant, which is adversarial, and you think of a property management company as being on the doorstep or on the threshold of home ownership for your renters, you start to think and you start to act differently. Yep. And this is one of the programs that you come up with. So super happy that we get to share this success. I know all of you really care about the folks who are a part of this investment as well, who are renting our homes. They're winning as well.
I love it. And speaking of winning, we have another breaking news. I'm going to share it here, but JWB has broken ground on 108 affordable housing units on Jacksonville's west side. GC, as I share this article, tell me a little bit about what's going on here and why it's different.
Yeah, we talk often about JWB's R&D department, and the things that we do. A very, very small part of our business is figuring out what's next. And one of the things that we have been working on for a number of years is a program called the Low Income Housing Tax Credit Program, or LIHTC. And this allows communities to build homes that are affordable, and they stay affordable for long, long periods of time. They work with developers like JWB, and what we do is come together to put the project together. And then for this project, we're going to share here in just in a second that we were featured on the news for, we're committing to keeping the rents affordable, 60% of the area median income or less, for the next 99 years. So in a world where affordability is a challenge, This project specifically is something we're really proud of, to partner with the city and many other organizations to bring affordable housing, 108 affordable housing units that are going to remain affordable for the next 99 years.
Two things I would love to bring up, GC. And first of all, I encourage you all to. We shared the link in the chat, right? Like I stopped sharing the news story here, but being on the news, really really cool. Two things I want to bring up. One is you have been building affordable housing for a long time, but mostly it's been focused on the single family side. That what makes this new is that you guys are coming out with some multifamily stuff, right?
Yes. So if you think about what determines affordability, if you want, you measure it by what percentage of the area median income are your rents. And so if you look at what JWB single family homes are and have been for the better part of 20 years, those would be defined as affordable in the single family sense. But what we haven't really done is partnered with the city to bring multifamily units.
Mm-hmm.
And so the city has special programs like the low income housing tax credit program that allows you to build multifamily units, to be able to receive certain grants to be able to do this. And then what you do as a developer is you put your flag in the ground and you say, this is going to remain affordable for rents for a very long period of time. And that's why the city does those grants.
Mm-hmm.
So this is the first project that we've actually partnered with the city and have made that extra commitment. Not only are we serving affordable housing today, but it will be that way for the next 99 years. And the really cool thing, if you guys go and check out the video after the show here, you'll learn a little bit about how innovative this project was. So what we did actually is we took 3 smaller parcels of land and put it together to put this project together.
Mm-hmm.
It would have been no way for those smaller parcels of land to remain affordable for the next 99 years if we didn't partner up and figure out some solutions to make this possible, to put those three parcels of land together. So 108 units here in Jacksonville, not only being built today to be affordable, but will remain affordable for the next 99 years.
Something that I would love to bring up, because I got to nerd out with Regal about this last week. Coincidence, right? This is it's like a different vehicle that allows you to do this, right? By putting together these 3 parcels, you guys were able to qualify for something that I learned about earlier this year, this like LIHTC, low income tax credit kind of like scenario for affordable housing developers that are, the way that it was described to me by another client of mine that I have in Altoona, Pennsylvania, is that it's really, really hard to come by these.
Yeah.
They only give it to people that can, like prove a lot that they're able to bring this out. But once you get it, you're in this like secret cool club of developers that are able to bring affordable housing to your community, in a different like expedited way, right? Like, am I right?
Yeah, it's really hard to bring one of these to the table. The amount of knowledge and expertise and the amount of people to partner with to do this, the funding comes from a number of different sources. It's not just a grant that the government gives you. You have to make the funding work. You have to bring on partners who have experience to do this. And so I think getting one done is a huge feather in your cap. There have been many people who have tried to get it done and couldn't get it done. So getting one done, getting it to the finish line, it's been a 2-year plus project for us. Gives us the confidence internally to know that we can do this. But I think externally within the city, they know, oh, JWB can deliver. And so we already have our next project in the works. The city is really excited about it, and we're excited about it as well. So next year we'll have our second LIHTC affordable deal, hopefully to share with everybody.
That's cool. The guy that shared it with me, he was like, I've been told that once you start working on these, this like secret society of people that do it reach out to you, and you're going to get indoctrinated in some kind of cool club. You see, that's what I like. That's what I,
you really like the fantastic angle, dramatic angle of this. All right. I'll pump it up next time.
Sounds good. Sounds good. Last but not least, MVP, who hasn't been here for a couple of weeks, is asking, hey, how much did JWB Cares raise from us investors? We gave that update last week, but let's let Lee know.
Yeah, we're up to almost $8,000 from our community has been raised.
There you
go. It is just so special. So thank you guys. We are almost to our goal of $240,000 overall. We've been raising money for over a year now. And our golf tournament, which is our big celebration of all of us coming together to raise the money, is September 21st. So we are super, super excited, super thankful to everybody in the community to be a part of this. And I'll continue to keep you updated, especially as we have some of our recipients who receive these $20,000 donations and down payment assistance grants to become first-time homebuyers.
8,000 is pretty good. Wasn't the goal 5,000?
The goal was 5,000. Yeah, last year we did 2,500.
Yeah.
So it's been, really a week to 2 weeks, and you guys just opened up your hearts, opened up your wallets. It's amazing. Thank you, thank you, thank you.
Interesting that the breaking news is all around this kind of like affordability stuff, right? Like allowing people to become homeowners. You guys bringing forth affordable housing, your charitable efforts of turning residents into homeowners. The headline that we're leading with, right? This article came out, this report came out saying that rents have increased so much in the state of Florida that now, in order to not be cost burdened in your housing expense, you need to have a salary of $77,500. Something that isn't the median salary in Florida in most places. And I want to kind of like talk about it, but first, from the definition of like what is being cost burdened and what is affordable to rent, this number of 30%, right? It's 30% of your salary. No more than 30% of your salary can go towards housing before being considered cost burden in housing. Is that a number that you guys use? Is that a number that JWBS property managers you look for in putting somebody into a rental property?
100%. It's one of the most important qualifiers for somebody to be able to rent with JWB because it is a time-tested affordability metric. When people have too much of their rent or too much of their housing costs, income tied up in rent, history shows that it's a struggle. They're burdened. And when people are burdened, usually, you have a greater chance for something negative happening, like them not being able to afford it.
Yeah.
You see this in terms of renting homes. You also see this in terms of mortgages.
Yeah.
When you're getting qualified for a mortgage, they're looking at what is your new mortgage payment going to be compared to your amount of income. So for JWB, we want to make sure that renters can afford at least 3 times the monthly rent.
Yeah.
Their gross income has to be 3 times the monthly rent.
Got
so
it.
There's your 30% right there.
Cool. So validating that piece. So when we saw this headline, I was like, Greg, I think we need to have a show about this because we talk about it a lot on the show. There is no state rental market. Right. Florida is, first of all, it's a big state. like this used to happen to me when I lived in Southern California, when like friends from Miami would be like, hey man, I'm in California, come hang out. I'm like, dude, you're in San Francisco. It's like an 8-hour drive, right? Same thing happens in Florida.
Right.
It's a big state, but it's essentially dominated. As rental property investors, we talk about this idea that you want to invest in markets with over 1 million people of population. So the major markets in Florida that reach that threshold are essentially 4, right? There is South Florida, which is the Miami market, Fort Lauderdale, and West Palm Beach. There's the Tampa Bay area of Tampa, St. Pete, Clearwater. There's the Orlando market, and then there's the Jacksonville market. And those 4 markets themselves are very, very different, right? Like, and we've talked about it. Miami has recently made headlines about being more expensive than New York now. Tampa Bay and Orlando are different all into its own, but like I think the biggest difference is essentially the people that live there and the industry there and how well it matches, right? Like for me, like I know that Miami, having grown up in Miami is a place that's built for people not from there, right? Like from its inception, when Henry Flagler brought the railroad down, it was winter homes for people in New York. Nowadays, it's a place where people from South America and Europe with a lot of money come and, like settle in there. While the economy, what pays its bills, has a lot to do with construction and tourism and hospitality. Orlando, we know, is a big, big hospitality market, right? The amusement parks, the restaurants, the experiences, the big employers there is hospitality. And then Tampa is largely, it has a large retail and tourism industry sector as well, while Jacksonville has this more balanced logistics, finance, healthcare,
military.
and the military, right? Like so very, very different types of markets, and they also have very different cost of living and price points. So I challenged Greg to say, hey, Greg, can we show this in statistics? And Greg, as usual, dove in and kind of over delivered. You want to show people
Man, I had so much fun with this little assignment you gave me because the more I dug into the numbers, the better it's going to look for good old Jacksonville here. You know, I look at these numbers probably once every 3 to 6 months, and I hadn't specifically looked at how we compare across the other major metros in Florida for things like rents, income, rent to income ratio, home prices. But I think as we look here, you're going to understand why Jacksonville is known to be an affordable market here in the state of Florida. So.
Yeah. So let's start with the rents, right? You looked up these rents. You just basically mentioned the same markets that I said: West Palm Beach, Fort Lauderdale, Miami, Tampa, Florida, Tampa, Orlando, and Jacksonville. And in that order, West Palm Beach and Fort Lauderdale have, oh, these are, by the way, these are single family rental homes of 3 bedrooms.
That's right.
Right. Like the original article that we opened up was a 2 bedroom, right? But this is more emblematic of the asset class that we invest in here with single family rentals. West Palm Beach, and this is the median rent for a 3 bedroom home.
Yep.
Of 3,387. Fort Lauderdale, median 3,338. Miami, 3,163. Tampa, Florida, at 2,184. Orlando, 2,160. Right. So this like South Florida affordability thing, obviously right there, over $1,000 more in rent than Tampa and Orlando, which are in the 2,100s. And then there's Jacksonville, which doesn't even break 1,900 at $1,819.
Yeah. I mean, if you want to see why people are moving to Jacksonville within the state of Florida, this is a big indication right here.
Yeah. So this is, again, what we're talking about, this idea of in these big markets, affordability just in like the rental number alone is a big indicator. But we all know that affordability is all in relation to income and the average income of an area. So you went another layer deeper. You looked up these SFR rates, the median income, and then the percentage of rent to income. And there is something truly shocking here in the sense that you would expect this kind of like descending number of rent price to be somewhat correlated with median income. And I don't think you can really put it up there, but West Palm is at 88,800, Fort Lauderdale 85,900, Miami is even lower at 82,200, Tampa, Florida at 83,700, Orlando at 86,000, more expensive than a lot of these South Florida, a couple of these South Florida markets. And then there's Jacksonville. I'm sorry, better income than the more expensive South Florida markets. Right. And then there's Jacksonville with a median income of 89,300. Jacksonville actually showing the highest median income in Florida.
I did a double take when I saw this.
Yeah.
I went right back to John Burns and I said, hey, am I missing something here? Because I'm about to share this with all our friends in the community here. And they verified this for me. Jacksonville now is the #1 highest household median income in the state of Florida, which even blew me away. And I know a pretty good deal about Jacksonville. I asked them, I did a double take on Miami too, because, I think of Miami as very wealthy. And I said, it's 82 too. Did I miss something here? And they explained, no, this is really what household median income is there. But they told me the caveat of, got to understand that a lot of people come from South America or Europe to Miami, and their income is not derived from salaries, right? So this does create a space for there to be more wealth in Miami. But if we're thinking about affordability here and who is most apt to rent the homes that we are potentially investing in, this median income number really, really matters. Yeah. And so then when you start to run this, the equation of rent to income, you see which parts of Florida are more rent burdened and which parts are not. Jacksonville having a rent to income ratio of 24% is the only market out of the major metros in the state of Florida to not be rent burdened for a 3-bedroom single family home.
It's really interesting, man. I mean, you obviously see South Florida being just like way over the top, right? Like this in West Palm Beach and Miami both at 46% rent to income. That's 50% higher. And Fort Lauderdale at 47, right? 50% higher than what it is to be rent burdened. Then you see Tampa and Orlando right on the edge, right? 30 and 31%. They're right on the edge. But again, industries there seem to be not the ones that are going to continue to support the increasing costs, right? Like the retail and the hospitality, those are not historically industries that go up with time that offer these high paying jobs. And then Jacksonville sits here with like a really well-rounded economy, 24% rent to income ratio. So space to go up with already the highest median income in Florida. Um, Pretty eye-popping, man.
Eye
Like,
popping for me.
yeah, like I have these conversations of um friends of mine in Miami. I've talked about this a lot on the show, how when we moved up here, my wife's income as a W-2 employee increased substantially
Right.
and has continued to do so. And she still talks to her. My wife's an architect, right? She works in top level architecture firms as a master's in urban design. And she talks to her colleagues back in Miami in the same office where they were or having gone to competitors, and their incomes have just not grown in parallel to hers. And she's just
Right.
like, I mean, there is another way.
I bet if you went on the street and you asked the average Jacksonvillian which city has the highest median income, household
Yeah.
income in the state, the average Jacksonvillian would not say Jacksonville. We could do what do they used to do on the late night talk shows? You'd ask that question or
Man on the
whatever.
street.
Yeah.
Yeah.
Nobody would say Jacksonville.
Yeah.
I didn't think that our median income had
I would have
clipped.
thought Tampa or Miami.
Right.
Right.
Yeah.
Yeah.
And I think that's, you know, it's kind of like how when you're so close to something that is really, really good, you're somewhat the last to know. Like we're the last ones to believe that our median income has gone up here, but the type of jobs that we have here are so necessary. They're not necessarily the sexiest jobs, right? They're not the big, tourist attractions and the economy to support that. It's shipping, logistics, fintech, right? Military, right? Like these are incredibly important jobs that have stability and increasing rates of pay that have eclipsed our sister cities here in the state of Florida. So.
And Ringmaster Drew Barnhill brings up a good point that we just kind of touched on, right? He says, I think it's more a reflection of W-2 workers and not remote and entrepreneur folks. Someone has to afford those house prices. It's true, Drew, right? Like that yes, these are W-2 incomes, right? But at the end of the day, I think what is intuitive is the idea that it's the W-2 worker that rents in median income scenarios, right? Like the folks that are independently wealthy or have their own businesses and or move around, right? Like they're not the ones that are long-term renters in the type of assets that we're investing in, is the point that we're making.
Yeah, 100% right. And that's why you'll see both things being true, that home prices are a lot higher in South Florida, even though when you look at the amount of median income here, that would support what you're saying, Drew, which is like they have their wealth in other places, which are why they're paying so much for the houses down there. But if we're thinking about it through the lens of how do I mitigate risk in this investment when I'm buying a rental property in the state of Florida, that median household income number is one you're going to want to pay attention to.
It's a big deal. And speaking of median house prices, right? Like you then went a step further, cost of living, median house price, and population growth rate, right? So I'll start with what's easiest to understand. The median house price in West Palm Beach is $672,500. Fort Lauderdale is $565,000. Miami is $635,000. Tampa is $385,100. That's actually surprising. It seems lower than I would have expected for Tampa. Orlando is 418,000 and Jacksonville is 365, right? So those are representative, and then you compared it to cost of living index. You want to talk me through the cost of living piece?
Yeah. So in my head, I was like, all right, we're talking about affordability here. Present day today, which cities are affordable or how unaffordable are they beyond just rent as well? And that's really what the cost of living index measures. Rent's a part of that, but it also is, cost of groceries and other things. And what you see is out of the 6 metros here in the state of Florida, Jacksonville is the only metro that has a cost of living index below the national average. The other cost of living indices are higher Orlando being 4% above, Tampa being 8% above.
Yeah.
But you start to get to South Florida, and that's where you're between 15 to 31% above for the cost of living index compared to the country.
Makes sense that Miami is 31% above, even though the pricing isn't, like it's not the highest pricing, because I find myself regularly spending $75 on breakfast in Miami.
Yeah.
Right. It's like, like you go out there and you got like 2 coffees, like 2 breakfast sandwiches, and you look at a bill and you're like, oh my God, I feel like I just went out to dinner in Jacksonville and had a couple drinks.
Yeah.
It's wild.
Yep.
It's wild. And then to boot, you compared it to the population growth rate. So why the population growth rate? How does that?
Well, so then I was thinking, okay, affordability today, and then I'm thinking about runway for the future too. So I'm from the lens of I'm buying a rental property. What's my runway for growth in the future? So I'm looking at the median home sales price and population growth, because I'm looking at how much home prices cost today, and population growth is a leading indicator for what home prices are going to do in the future. If you have more people moving there and a higher population growth rate, that's demand for housing, and that would mean that you would see higher home price appreciation in the future. So we're kind of looking at where we are today and what's the runway for future growth. And so when I looked at population growth rate, I thought it was really telling. Now, population growth in the state of Florida is high compared to the
And this is an average over the last 10 years.
That's right.
Bears to be said.
Yeah,
right?
From 2016 to 2025, I pulled the data on it. So over the last 10 years, because I didn't want to just take 1 year or 2 years or 3 years. And I actually wanted to normalize beyond COVID as well. But you see big differences. All of these percentage growth rates are higher than what the national average is, because people are moving to Florida, right? So that's a good thing for housing demand. But you see big differences. You've got, West Palm and Miami and Fort Lauderdale somewhere around, call it 10%. For growth rates. It goes from 10% to 12% for those three. Tampa has 15% population growth rate. Orlando actually is the most at 22%, but Jacksonville is right there at 20.5%. So not only are we affordable today from rents and cost of living, our home price is a lot lower today.
Yeah.
But we're gaining on it, and our median income is the highest today.
Yeah.
But we're gaining on population as well compared to the rest of the state, which supports higher housing demand and which supports the thesis that this is a place where your assets can continue to grow.
And then below here, you put the #1 fastest growing population in Florida in 2025.
Yeah, that's real. We were the #1 fastest growing population in the state of Florida from 2024 to 2025. That more than any of these on this chart. And nationally, we were the #6 fastest growing population in the entire country.
So continuing to gain steam. I mean, I keep reading these articles about how Florida is contracting. Right? Like those are the headlines I'm seeing. It's like there's an out migration of Florida. I think a lot gets weighed into, like you're looking at numbers in mass. You look at this like giant market in like South Florida, so it's going to weigh a lot of these things down, and then these other cities as well. Just not our reality in Jacksonville, right? Like it may be slowing down in other parts of it, but I think it's pretty easy to understand why there's a bubble here in Northeast Florida when the rest of the state has lower median incomes, higher home prices, burden people that are renters. There's people going to the place that has high median incomes, below average home pricing, affordable rents, and like plenty of opportunity and still upside happening. So like, yeah, anyways.
When you say bubble, you mean like a safe place.
I mean,
not a real estate bubble.
I don't mean like a market bubble. I mean, it feels like I feel like I live in a bubble when I live in Jacksonville, right? Like I read the headlines of everything that's happening and the economy and this and that. And I talk to people and their experience and like my friends in California and South Florida and in the Northeast and all these different things. And I'm just like, I just don't feel it, right? It feels like I live in a very prosperous area and these numbers support it, which makes sense why people are looking around and making a move to here.
Yep. Good example of how we have to separate the noise.
Yeah.
There's a lot of noise out there. And if we generalize and throw these statements out there, it can lead to incorrect conclusions. And that's what we're seeing here. If you read an article that says that Florida is unaffordable, or Florida is not a good place to invest, or Florida insurance rates are prohibitive, None of that's true in our little section up here in Northeast Florida. It's just not the case when you dig into the data.
So if I was to segment noise, right? So like I guess there is I travel a lot, as you know. A lot of the time when people are like, "You're from Florida," and they have like they have all these like um prejudices. We do the same thing, right? We say the same thing about Californians or New Yorkers or whatever, right? So like I think it's completely normal. But if I was to isolate the noise coming out of the real estate market in Florida, um, noise is this article of like Florida's becoming unaffordable because the wages aren't keep, like the median wage needed doesn't match the cost burdening statistics of being a renter in Florida. Noise is Florida is contracting because there's an outmigration from like these other cities in Florida that's happening. Those are things I'm hearing. Noise I'm hearing is Florida insurance rates are making everything unaffordable. Those things, while maybe like in an absolute Florida statewide statistic might be accurate, not true inside of Jacksonville where these dynamics are not real. So it's important to separate those things.
Yeah, and I'd really question if it's even accurate from a statewide perspective as well. I've seen a lot of those articles. I dig into it. Another bit of noise is they've said, "Oh, Florida home prices are declining. Florida's, crashing and all that." Just not the case. A common thing that I've seen is they've compared home prices from one month to the next month. That's just not the way that you compare home prices. So I think there's a lot of noise out there. I think you really got to know and trust your sources, and it takes some work. It's just much easier just to read a headline and then just, process it and then just share it, but it takes real work to actually understand the data behind it. And that's why we're here. We're here to do the work for you. And I'm glad that you show up.
Yeah, that's why we're here. Excellent. Just real quick, we only talked about the major markets there. I just kind of flippantly said we only invest in 1 million plus. Just talk a little bit more about why we don't talk about the smaller markets as far as the long-term investment goes.
Risk mitigation.
Yeah.
We need to make sure this model is built on your ability to have a renter in your home paying rent. That's what supports this investment
over 10 to 20 to 30 years.
Market.
Right. Yeah.
And so we need to make sure that the jobs and the economy is strong to support that renter being in that home, or any renter being in that home for a 10 or a 20-year period of time. If you go to very small markets where you have less than 1 million people living there, you're just not going to find the same type of economic stability. When you have over 1 million people, you'll see things like Fortune 500 companies are headquartered there, or strong employers like the military or Amazon distribution facilities.
A diversity of industries, not just one industry.
Right?
Yeah.
That's really important. That's like the bedrock of where you want to be investing, to make sure that, one bit of economic news doesn't take that one employer, have them close up shop, and then your entire investing thesis is, struggling.
Yeah, correct. So like the other noise that also comes from these other smaller cities that people rush to, invested in, didn't work out. Right. There's much higher swings. These bigger markets are more stabilized. That's why we talk about it, GC. So the big kind of like aha here is Florida may have some macro numbers, but nobody is investing in a macro real estate market. Know your local market. It just so happens that Jacksonville, Florida, all the indicators are pointing to good. So like you can't throw the baby out with the bathwater. Speaking of other noise, GC, rates, right? The Fed and like what's going on with mortgage rates and all these different things. We had a show, feels like a month ago, that talked about Bank of America predicting 3 rate hikes to be coming before the end of the year. Recently, another headline saying expecting rates to go up in September. And I'm like, man, we should really talk about this. There's a new headline. What should we do? And then all of a sudden, rates actually dropped a little bit in August, right? So trying to make sense of this like rate movement. I challenged you once again. You came up with some good data once again. Tell me what you were thinking.
Yeah, we did a deep dive on why rates were doing certain things, or why was the market predicting that there would be rate increases the last time. So I thought we would first start there just to kind of level set. And I'm going to try to take you down a different talk track this time. This was the slide that I showed. This is showing this dot plot. And so every few months, what happens is not only does the Fed get together, it's the Federal Open Market Committee, I believe, FOMC. And basically all the Fed presidents get together and then they have a closed door meeting and then they do a lot of things. They vote on what the Fed is going to do. Are they going to keep the Fed funds rate the same, raise it or lower it? And then they also do something, they make their predictions of what the median Fed funds rate will be for the year. And so this is that dot plot that I shared with you last time. The big news about it was the current rate was 3.625, but the dot plot, which is what the Fed presidents predict the median rate will be for the rest of the year, was actually higher. So you've got the people who are voting on what the Fed funds rate is going to do, saying, I think the median is going to be higher. And then the market perceives that the way it should, which is the people who are making the decisions are much more likely to raise the Fed funds rate. And so that was the big noise there. And after the dot plot is when Bank of America and many of these other institutions came out and they said, we predict 1 rate increase, 2 increases, or 3 Fed funds rate increases after that. And then the world's like, oh man, rates are just going to go up. And then, you know what happens? A lot of investors just sit on the sidelines.
Yeah.
Because now they're scared.
Yeah.
That rates are going to go up and it causes, I think, it has a lot of ramifications, but one of the things it causes in our little bubble here is inactivity, inaction.
Yeah.
Because now people are scared of rates.
Yeah.
So that was just me setting the table. That's where we were a month or so ago when we did this. Well, now if you look at what is the expectation of the Fed funds rate increase, it's actually a lot lower today. So there has been this rather large shift. So I'm going to take you down the timeline here. The first part of this slide shows June 17th of 2026. There was a 29% probability of a September 16th rate hike. This is the Fed funds rate because September 16th is the next day that the Fed gets together and makes that decision. So this was before the dot plot came out. Then the second part of this in the middle of the slide is June 18th, the day after the dot plot was released. And the market reacted and said, oh, geez, now there's a 67% chance that there's going to be a rate hike in September. And now investors get scared and then they sit on the sidelines. You know, as we're sitting here today, there's a 37% chance. So we're basically right back to the same percentage chance we were of a rate hike before the last dot plot came out. So the reason I'm bringing you through all this is because I'm showing you that this stuff changes all the time.
Yeah.
You know, a bit of economic news and the market goes haywire.
In this case, the economic news was inflation was still higher than expected and jobs were not as strong as expected.
Yeah. So that's what has driven it down from 57% to 37%. The dot plot hasn't changed. That's the last available dot plot.
Yeah.
But what also has come out is news that inflation has cooled, like you mentioned. So CPI is a little bit lower than expected. And then we've actually lost more jobs than we expected as a country.
Yeah.
Which sounds weird that would be a good thing for not having a rate hike, but having more and more jobs actually leads to more inflation. So when the market perceives that we've actually lost jobs and more jobs than we expected, then that is something that decreases the need for a rate hike by the Fed in an investor in the market's mind. So, you know, there's 1,000 billion gajillion data points out there that affect the probability that there's going to be a rate hike. And you know what? Even if there is a rate hike from the Fed, sometimes that has no bearing on what our interest rates actually do.
True.
Sometimes the Fed raises the Fed funds rate and our 30-year mortgages go down.
Yeah.
And sometimes the opposite's true.
Yeah.
So it's like, you know, the talk track that I wanted to kind of bring you guys through here is just to show you how fickle the market is and how much it is likely to change between now and September 16th as well. And so there are some of us who just get scared about interest rates and sit on the sideline, and there's an opportunity cost to that. You know, there have been many, many investors that have been in this environment where interest rates have been higher than we all wanted for years now, and they have sat on the sidelines, and they have justified that by not wanting to have higher interest rates. And ultimately, when you look 10 years from now, they're going to look back and they will have lost a lot of potential income and growth by doing that.
Yep.
And there's always a reason to sit on the sidelines. Interest rates are one of those now, but what I see and what I do with my own investments and what I help clients do is to think about interest rates as temporary.
Yep.
Anyways, because the best way to grow your portfolio is to think of your interest rates as temporary, because in 5 to 7 years, what is most likely is you're going to have built up enough equity that no matter what your interest rate is going to be, it's a better move for you to change it and pull that equity out and put it to work for you. I was just working with a client earlier this morning. Interest rates, 6 loans that were sub 4%. And I was able to model it out with this client. I said, hey, listen, we could keep those 4% loans or sub 4% loans in place. And here's what it's likely to look like for your JWB portfolio in 10 years. But if we refinance those and then we add more properties to the equation here, here's what it's likely to look like. And it was over $1 million more for what this client would likely grow their portfolio. But they had to get rid of the 4% interest rates.
Yeah.
And it helped them become excited about doing that. So, overall, I would not get too excited about whatever the market is saying about the chance of an interest rate increase or not increase or a decrease or whatever. It's likely to change between now and whenever it happens. And then whenever it happens, it may or may not even affect the interest rate that governs your investment here with JWB. And then even if it does, it's likely to change in 5 to 7 years anyways. So I think overall, we pay a lot of attention to interest rates, but we need to pay more attention to the fundamentals of the asset.
Yeah. It feels like we move more and more into this world where everything that pings requires our attention. And if you are not, if you don't have these kind of like these lenses, these long-term lenses that you like to put on things, it's so easy to become a prisoner of the moment. And it's so easy to like subscribe to this idea that I mean, for me, like I fight it every day, like this tweet economy that we're in, and like whatever the latest thing is gonna swing these different things. And one of the things that I most like about investing in buy and hold single family home, workforce housing, rental properties is the idea that it is a constant need. We will always, like it is always going to be needed. It is constantly undersupplied, right? Like the math of like how do we actually catch up to the demand of how much this is needed is daunting, and like we don't have a solution for that yet, even though we try to keep looking for it. And knowing that being able to put in something that is so fundamentally solid, that also happens to have a really nice return profile based on like my other options of what I could think about as a long-term investment, is a like moment for me, right? It's like a pressure release moment for me, and continuing to like be on this show with you and be like, headlines are saying that Florida's unaffordable, but like look at my local dynamics on my investments. Interest rates are going to be doing whatever they think they're going to be doing, but like at the end of the day, I'm able to just like lock in these things and know that it's over time, it's going to do its thing. I think it's just like a message that bears repeating, which is why we continue to dissect these headlines on the show and talk about what it means for buy and hold.
It's tough to find something that you can invest in and just sleep well at night.
Yeah. Yeah.
But there's a place for boring in this world right now. There's a place for boring when it comes to how you're going to retire.
And that's the last thing that I challenged you with here, GC, right? Like, it's like, hey, I think that one of the things that we under talk about right now is this idea that it's a really good time to buy in Jacksonville. Like if we say that on every single freaking show, people are just gonna be like, shut up, Greg. So like we kind of limit you to saying that once every 3 months for the market update. But in lieu of these headlines, in this idea that right now there is the opportunity to lock in a 3.9% interest rate when you buy a JWB property, I wanted you to put in perspective kind of like what a rental property investment in Jacksonville looks like right now. So, I asked you to show us a property and like how it's all working right now. And this is a new construction rental property in Jacksonville, 4-bedroom, 2.5-bathroom, purchase price of $280,000, well below the median pricing. Cause again, we're in workforce housing homes. Um, all the numbers are in it. And this is at the end of the day, the return profile. You want to talk me through this, GC?
Yeah, if we just help everybody just get off of the sidelines and take the noise and take all the reasons to not act and the high interest rates, and you just look at the fundamentals of the asset today, along with some really special financing terms, like it's just a win. It's a win. And if you compare it to how much people have, what the opportunity cost for investors has been over the last 5 years, you can see that's life changing. So here's this house on Ottawa Avenue. It's one of the currently available homes for JWB. JWB clients are able to get a 3.99% interest rate. Now we still waive our first year of property management fees, but like this is the type of asset you can invest in right now and just know that you can sleep well at night as you're building towards your retirement or sending your kids or your grandkids to college or whatever it may be.
Yeah.
You put about $80,000 down here, you get that great interest rate. Your total return on investment is estimated at 13.2% per year for something that's boring, something that's it's not the latest AI tech craze or fad, and initial cash flow right out of the gates because of this low interest rate are over $200 a month. $200 a month is not going to change your life, but what it does is it creates that extra layer of stability so that you stay in the game for a full market cycle.
Yep.
And then over the next 10 years, right, this is what this investment can do for you. Assuming that the market continues to appreciate just like it's done on average for the last 40 years, that property that you purchased for $280 today is going to be worth about $448 in 10 years. Rental income is going to grow. It's going to be up to about $2,500 in 10 years, but you still invested $80,000. Your portfolio would have grown about $170,000 to put you right at a portfolio value of about $250,000. And that's that 13% return on investment working for you year over year over year. And something that is stable, consistent, boring, that the family needs, the community needs, the government needs to work. And it's not just subject to the same whims of the crazy world that we see right now. This is the type of investment that can secure your retirement.
Yeah, man. To me, this is it. It's like what Drew says. It's a security blanket, right? Like Eddie Harris is saying in the chat, I think our secret weapon is we have workforce housing rentals hitting the sweet spot for increasing job opportunities and downtown traffic. And letting this thing do its thing over time while, providing a critical need instead of relying on these winds of change, right? Like for me, the core thing is you're looking at a local market that has the best kind of like numbers of anything close to it, right? Like in the state that people want to move to, all in front of all the trends, right? So like the fundamentals of where it's what the median income of the local market, the migration population, right? Like that is like future upside. The right now snapshot of being underpriced in comparison to everything else. You expect those things that are going to continue. All of that stuff is in place with being able to lock in your biggest cost for something that's a revenue driver, which is a mortgage expense. Let it do its thing over time, continue to raise cash flow, continue to build wealth, rinse and repeat. Feels like a great place to be.
There you go, man.
Good show today, buddy.
Yeah, man, this is a lot of fun, man. I think you set me down a really good path. I'm so glad that I did the research, and we've got a lot more verifiable marketing claims we're going to start putting out there about Jacksonville's median income and about, our population growth and whatnot.
I get excited when I see an email from you on a Saturday at 10 in the morning of like slides for Tuesday's show. Because I'm like, oh, my boy just went down the rabbit hole.
You had like 2 or 3 of those Saturday emails coming the last few shows. It's a good one too.
It's just so everybody knows. It's not always on Saturday. Sometimes it happens at 12:20 on a Tuesday.
That is true.
Because my guy is just like, oh, I gotta do it. But like for these past couple, like I feel like you caught the scent of it and you chased it down to some like really, really conclusive evidence that is flies in the face of the noise out there and brings some like real perspective. Data plus perspective, which is what we appreciate this show for.
You know what? Happy to do it. I think it's pretty awesome.
I love it, GC. I don't have actually, hold on. Let me pull up what the next show is going to be about here. I'm struggling over here. It is 3. Jesus, I have everything in front of everything.
I wish I could help you here.
You know what? You know what?
Totally forgot.
I'm going to skip it. I'm going to skip it. I'm going to thank the community. We had like 76, 77 people on average here the majority of the time, middle of a workday on a Tuesday, taking time to come here, get educated on rental property investing, connect with other people, keep bringing us the great ideas that you keep bringing us, and we'll continue to send GC down these rabbit holes of data and perspective to keep bringing a little bit of sanity to this like very, very noisy world. So I really, really appreciate the community being here. GC, I appreciate the work that you're putting into these, man. I think they're really, really awesome, man. And I'm learning a lot and giving me a whole bunch of new stuff. Oh, there's a question that just popped up. Let me see here. Darren Seaman says, another topic entirely. Any opinions on agricultural enclaves? It's in the news lately. Maybe we make a show about it.
I don't have any opinions as I sit here today, but I'm sure we could form some.
I'm sure we can, Darren. We will add this. Joanna, let's add this to future Not Your Average Insights. Let's look into agricultural enclaves and put some data and perspective to it.